Boston Beer Company. This is ticker SAM, and it's the largest American alcoholic beverage company after many mergers and acquisitions that have taken away the much larger players and caused them to be parts of international conglomerates. Boston Beer Company is the number one player in craft beer segment, hard cider, and flavored malt. They have very strong turnaround prospects after a dismal 4 years of challenge following the bursting of the hard seltzer market. We'll get into plenty of detail on that. Company has a long track record of innovation, developing new products, and executing operational turnarounds during times of stress. It's still a founder-led management team with deep marketing and operational expertise. They have a debt-free balance sheet, something that you don't often see in a stock that's down 85%, which enables internal reinvestment opportunities and allows them to repurchase what we think is quite undervalued stock. We see 60% upside to our $300 plus fair value appraisal using multiple methodologies, and we think the upside could be actually much higher in the upside scenario or in a takeout scenario. So before I jump into Boston Beer, I'll just post, as I do every year, our prior picks just to sort of keep us honest. These are our picks for the prior 10 years. And you can see we track sort of when we recommended them, how well they've done after 6 months, 1 year, when we exited, and had you optimized it and gotten out of the best possible point, just as a reference. We've had a couple of losers, but mostly pretty good results. Our losers were Diamond Hill and Atcor, although that story is not completely done since we sold half the position on the first run-up and converted the other half to a call option position. So we'll know completely how that's done after that plays out. We've tended to do much better with our growth picks than our value picks, so I'm taking a big risk here with a contrarian value pick in Sam Adams, but there are some growth features in the company. We still hold two of these OTC markets from 2018. We continue to hold this and still like it. And Uber from last year, we continue to hold it. It's actually done quite well in the first year since we've picked it, and we still like it. So with that, I'll move on to Boston Beer. So here are some of their main products. The largest product is Twisted Tea. This is a product they invented and launched more than 20 years ago. And it's number one flavored malt beverage. They have 90% share of the category. This is a tea-based alcoholic beverage. It's had tremendous growth, but that growth is beginning to fade. Next is the craft brew segment. This is the heritage of the company when they were launched in 1984. This is Sam Adams Beer and all of the different variants and offshoots of that and various other brands that they've either acquired or created. This is still a very small share of the total US beer market, which means there's a lot of opportunity to grow, but we're also seeing a lot of signs that this segment has become mature as a lot of competition has entered in recent years. Truly is a hard seltzer. They're the number two player behind White Claw. They created this product internally and launched it, and it had astounding growth, grew to $900 million in sales, almost 45% of the company's sales at the peak, followed by a big crash. And it's been declining now for several years. And we're trying to see, are we seeing that decline rate diminish? That would be a key part of our analysis. On the lower left, you see Angry Orchard. This is another internally created brand from their own innovation. It's the number one player in the hard cider category. This was a forgotten, dormant category when they launched this brand a number of years ago, and they've reinvigorated it, and it's now become a stable contributor in their portfolio. Sun Cruiser, middle bottom, that's a new product that's being launched. We think it's very promising. It's been successful in its regional launch and is about to go into a big national rollout. Sam's American Light, we view this as a high-risk, high-reward new product launch. It's going after a huge market where there might be an opportunity for a higher quality light beer. It's been very hard to dislodge the kind of oligopoly of Miller Lite, Bud Light, Coors Light, but this is an attempt to do that. It's actually their second attempt to do this. So these are the core products we'll be talking about. I should also point out there's a perpetual innovation process going on at the company. They are constantly tinkering in the lab, constantly inventing new brands and products. Here's just a smattering of a few of them, but there's literally hundreds of these new products that they tinker with and try to determine. Most of them flop and fail. They never launch them. They might just put them in their tap rooms for consumers to try. They might test them on consumers. They might launch them regionally, but many of them just sort of die, but there's learning from it that becomes relevant later. So you can see there's cannabis-based beverages they've experimented with. There's collaborations with the Grateful Dead. There's Mountain Dew, Hard Mountain Dew Code Red, which is dedicated to preventing the 2% of the world's population that has red hair from going extinct. There's the tap rooms that they serve this in. They have Dogfish Brewery that they acquired, which has also produced a lot of crazy, innovative beers like rotisserie chicken flavored beer and a wide range of others, some of which have gotten traction, some of which haven't. Collaborations with Jim Beam, collaborations with Pepsi. So extremely interesting company. Angry Orchard has its own orchard in the Hudson Valley where they take lots of visitors. So there's a lot of brand equity being built through this process too. So timeline of the company founded by Jim Koch in 1984. He's kind of a legendary guy in the craft brew industry. The story goes, so we're told he found his great grandfather's recipe up in the attic and decided to brew some beer, and then just went up and down the street and convinced a few bars and pubs to carry his product, and then eventually got a tap put on in those locations, and just step by step built the company from nothing with just a couple of people helping him. Then it released Sam Adams Lager the next year, released Double Bock. By 1992, they were distributed nationally. And then by 1995, they were able to go public on the New York Stock Exchange. And then they've done a series of acquisitions of smaller companies like Oregon Ale, where they were getting access to brewing capacity and also maybe some brands and relationships. In 2001, they introduced Sam Adams Light. This is a key point. It flopped. It didn't succeed. A lot of people actually liked the beer, but it didn't succeed commercially. So we'll come back to that in the context of American Light, that they're attempting to do this again now, 24 years later. The same year, they launched Twisted Tea, which just seemed like a little project back then, but it grew into a massive $1 billion brand, which is now half of their sales. Who would have known at the beginning it could be that huge? 2011, they launched Angry Orchard, which I mentioned, which now dominates the hard cider category. Then in 2015 to 17, it became a difficult period. Sam Adams' core brand kept growing, and then tons of microbrews launched businesses, and the space got very crowded. Store shelves were full of craft beer. Many of these companies were unprofitable, led to sort of irrational production, oversupply of inventory, and then a massive shakeout occurred during that period. Sam's results fell, their operating margins crashed, the stock had a massive drawdown. And actually, it's the first time we invested in the company was during that downturn. It's with sort of a similar value thesis that we have during today's environment. So that took a few years to rationalize. A lot of failing competitors exited, but it did cause the space to be mature. It also caused the US beer market to have a lot more selection and choice. People have always complained that the US beer is terrible and that in Europe you have all these great regional brands. Well, now the US is arguably the innovation hub of high quality beer globally. And that's one kind of benefit of that period. Truly launched in 2016 as a hard seltzer. It obviously became very successful. 2019, they acquired Dogfish Head, which has grown to about a $100 million brand. Not super high growth right now. It seems fairly mature, but it's sort of acting as an innovation lab for the company. Sam Calagione, who started the company, is on the board of Sam Adams and is the second largest shareholder after Jim Koch. And they provide a lot of ideas and experimentation. And it's become a bit of a lifestyle brand. They also have restaurants and inns and kind of experiences that they sell in addition to just beer. 2020, they hit 7 million barrels of beer, so it's making them a much larger player. And then now, 21 to 24, hard seltzer bubble bursts. Everybody locks down for COVID. All these categories took off as people were sitting at home and sort of just consuming hard seltzer in small groups and outdoor parties. And that was kind of the peak of the hard seltzer market. And that's had a tremendous impact on the company since it was their largest product, and it's now truly has lost about two-thirds of its value, two-thirds of its revenue. 2024, Sun Cruiser was launched in 14 markets. Now it's rolling out nationally after a lot of success regionally, and then Sam's American Light. So what's the moat? This is a Wide-Moat conference. So we think there are four major components to the Boston Beer moat. And in order of value, number one, brands. They have multiple leadership brands in their segments: craft beer, hard cider, flavored malt beverages. Strong consumer brands reinforced with good media. There's a lifestyle experience. There's 2 million consumers visiting their breweries every year. There's a very hardcore group of consumers that love the company's products. And many of them are actually stockholders too. They maybe own 10 shares. Deep understanding of consumers. It's a very good marketing team that really is constantly researching and trying to understand the market by getting out into it at the street level, and long track record of innovation. So second piece is distribution. I think this is actually just as important as brands, actually. The company has a national distributor network that's been built painstakingly over many decades. The US has a three-tier distribution system with manufacturers, wholesalers, and retailers, and to build distribution is very difficult, very expensive, takes a long time. Many new brands try and fail to get distribution. This gives them shelf space at retail that they've earned over many years. They've got a very street smart grassroots sales force that's out calling on distributors, getting their product placed, helping the distributors succeed. They've constantly been ranked number one in this beer supplier survey the distributors do called Tamaron. The company's also built its own tap rooms, which sort of serve as flagship locations to drive trial. There's one in Boston, there's one in Cincinnati, there's a few in other cities. Think of these kind of like Nike stores or big flagship locations to attract attention, to expose people to new products, generate awareness. Third, regulation. This is a heavily regulated industry, both at national level and state level. You need licensing across all the functions of the business. It's super expensive, lengthy permitting processes. It covers production, distribution, warehousing, the ingredients you can use, the marketing claims you can make, what you can put on the label. Excise taxes are complicated, very difficult for a new entrant to come in and navigate all of this and do anything more than being a tiny regional player. And then finally, scale. Obviously, Boston Beer is much smaller than Anheuser-Busch or Miller Coors, the big players, but in the craft segment and in the spaces they're occupying, they have high market shares and they do have scale advantages in those spaces. So it gives them procurement power for buying cans or hops and rolling out technology. They can spread their marketing costs over more barrels, the media buying, the ad spending, the launch of line extensions. So these are all moat components. I don't think this has as large a moat as my last year pick, Uber, which has had the two-sided network effect. But I do think this is a reasonably moaty company, even though it is a competitive business. So despite that moat, the last 20 years has not been a smooth ride. As you can see, this is sales growth. You have these big surges of growth followed by the company goes flat or negative for a couple of years. It seems like this happens every 8 to 10 years. The global financial crisis was one cause of it. Consumers really pulled back. The next one was when the craft beer bubble burst in 2015-16, and now we're going through it again. We've been going through it again for 3 or 4 years now as the hard seltzer bubble has bursted. What's interesting to me, though, is that each time this happens, the company surges back to life, usually from innovation, new product launches. And each time they surge back, the revenue growth is higher than the prior time, even though the base of revenue in the company keeps getting larger. So we're now 2 billion of revenue in the company. Can we have another surge of growth like we've had here? We're certainly not, as you'll see later, modeling sales growth that's going to be spiking to 25, 30%. But if they have some huge home runs, it's going to be one home run scenario that could create even more value than we're going to model. So breaking it down into products, we've modeled out, and they don't release this data, so we've had to piece this together from a variety of different sources, sort of form a mosaic of sources to try to estimate what the size of each of their brands is in the marketplace. And as you can see, the Twisted Tea, as it launched and grew and inflected up in 2018, became the largest product, just as Truly was declining. So these have really offset each other. They grew together for a few years, Twisted Tea and Truly, in 2018 to 2021. Then they offset each other. And now we've reached a point where maybe they're both starting to decline together, which is a concerning point, which is one of the reasons the stock is down so much, is people fear that the company is going to go into negative growth. So we need to really analyze that. The green line is the traditional craft beer business, Sam Adams and Dogfish. That's been stable to mature. Same with Angry Orchard. We're not expecting any significant growth in those products. And then Sun Cruiser is the light blue line at the bottom. That's the new launch. It did about 40 million in sales last year. It's going to do about 100 million this year. It's just about to go exponential as they roll nationally. And then American Light, I think it's more of a wild card how it's going to do. more chance that it flops, but it's also just kicking off. So it's really a battle between those two launches. How big can they be over the next 3 to 5 years? And can they offset what's going on with this truly twisted tea dynamic? We actually have some Nielsen, which is sort of the grocery tracking data here that's very recent, past few years, up to the last couple of weeks, showing twisted tea growth has really fallen off, and it looks to me like it's about to go negative. Not surprising, just given the tremendous growth that it now has to digest as new products come into the market. Consumers are kind of get tired of the same thing. So we've got to figure out where this is going to stabilize. What level? Is it 10% below where we are today? Is it 20% below? Is it 50% below? And then also Truly on the bottom right chart, here's another tracking chart which shows that it's getting less and less negative. The second derivative appears to have turned positive, was declining at a rate of 30% a year. It's now down to the mid-teens rate of decline. And are we finally going to see some stabilization? And so we model how long that takes in our different valuation models. So let's talk about the new product launches since they're critical to continuing to grow the company. Sun Cruiser is where we think there's the greatest opportunity. They launched in 14 markets. Reception has been really good. Consumer uptake's been really good. They've chosen to roll it out nationwide this year. So it's almost inevitably going to grow. They're putting a lot of money behind it, heavy investment. So, that's also going to hit operating margins. But the goal is to build a brand that can persist for 8 or 10 years and become a brand like Twisted Tea was or Truly, or maybe another billion-dollar brand. They're attacking the space that High Noon has occupied for a while. This is the highest selling spirits brand in the US, 1.3 billion of sales. The positioning of Sun Cruiser is a bit different. It's a vodka and tea-based beverage versus High Noon being a vodka and fruit juice based. Premium ingredients, real iced tea, no carbonation, very low sugar. Positioned to a higher price point, so it should be margin accretive to the company. And it's sort of a cleaner drinking product than a twisted tea. So while twisted tea as tea-based, it's not as sugary, it's not as heavy, it's a better quality of tea. It's a more clean, refined sort of drinking experience with Sun Cruiser. Distributors are reacting very well to it. A lot of surveys have shown high approval rates, and the market share has doubled from 1.4 to 2.8% just since January of this year. So things are off to a great start. We're modeling in 300 million peak sales to 900 million, depending on our scenario, as you'll see later. Sam's American Light, this is the super high risk, high reward category. They're attacking this massive, easy to drink light Pilsner beer market in the US to try to grab some share from Coors, Miller, and Budweiser, Bud Light. They just launched similar timeline as Sun Cruiser. This is going to be, I think, tougher to do. They won some awards. I've looked at a lot of reviews of the product. People seem to say, okay, great, it's better than your average light beer. The goal of this beer is not to create an amazing, dense, heavy beer with some thick taste to it. It's to really go after that refreshing, high volume, very drinkable beer market. They tried Sam Light a number of years ago, like 20 years ago, and it flopped. It was a really good beer, but it was too heavy to be drinkable and really attack the light beer segment. So they've learned from that, and they've made a product that is lighter, paler, and more drinkable, which if you're a Sam traditionalist, you probably think it's sort of a watered down beer, but really the comparison point is how does the Bud Light drinker perceive it? How does the Miller Lite drinker perceive it? They've got a natural advantage in that they can sell it alongside the rest of their product line. They can cross-sell into the grocery trade and get more shelf space, leverage their distribution network. So we're modeling this as everything from a total zero in a few years that just flops and they pull it off the market to 380 million. So we're not at all modeling a really successful scenario. So we're treating that as a call option. And then finally, I'll mention just in passing Hard Mountain Dew. This is another new product launch from 2022. They went into 9 markets. This is a collaboration with Pepsi. It's trying to leverage that cult following of Mountain Dew and put a sort of an edgy buzz to it with alcohol. Interesting, unique positioning. They're selling it into impulse channels like convenience stores. Early results were okay, not great. There was a lot of fanfare about this brand when it was first conceived, and I think that's kind of faded a bit. But they're still going to roll it out anyway, so I think you'll naturally see some growth just because of the rollout. But if it doesn't really get follow-up and traction, then I could see this thing being a flop. So we're not modeling any value for this, but it's just sitting there as another call option. Okay, a few words on management. Jim Cook's the founder. He still owns 20% of the company. He draws no executive salary. He was CEO for a long time. He now sits in a chairman, brewer, founder sort of role. He's very involved in the company. He still supposedly tastes every batch of Sam Adams that is produced. He flies 100 times a year to go visit market locations and talk to the trade and get involved with the consumer and talk to different colleagues. He's got a very folksy image, but he's a very analytical, very savvy business person as well, former BCG consultant. He's savvy about marketing, he's savvy about operations, capital deployment. So I'm very happy having him at the helm still, and he doesn't seem to want to go anywhere. He's got a pretty good team behind him, very experienced, seasoned veterans. Mike Spillane became the CEO last year after being on the board for, I think, about 8 years. And the board is full of people who have very relevant experience in consumer packaged goods companies, very successful careers, long careers with lots of promotions at places like Nike and PepsiCo and Domino's, also Uber, which we pitched. So I like the experience of the board. The salaries of the management are very reasonable given their level of experience. And this team is just very creative and they like to experiment. They are also good at the execution side of things. And I think it's a great team. They also are involved in the community, and the company has sponsored entrepreneurial programs for emerging craft brewers. They were actually a big part of creating a lot of their competition back in 2015 and 16 by giving grants to upstart brewers when it was a much more of a kind of cottage industry. So I'll summarize the key parts of the investment thesis, then I'll summarize the key risks and concerns I have, and then we'll get into valuation, and then we can open it up to Q&A. So key points, contrarian value pick. This could be an important inflection point here. The street is incredibly pessimistic about this company. Three-quarters of the ratings are hold, sell, underperform. Um, I think one of the best analysts on the stock is Bonnie Herzog at Goldman, and she has been consistently correct in her negative call on the stock for a number of years when it peaked at $1,349 a share in 2021, all the way down to $186. She does very good detailed work. Um, so I think they've been very correct on it, but I think we're reaching a point of change. That's my bet here. I think truly declines are moderating and the new products are going to be additive, and the stock is priced for them not to be additive in a great way. Defensible moat, the brands, distribution, regulatory barriers, and scale, the innovation we've talked about, the R&D pipeline. Even beyond the new product launches I mentioned, there is an R&D pipeline that's looking at hundreds of different opportunities. There's also the free call option sitting in there that one of those things could really hit. We model that being zero in most of our scenarios, except for in our upside scenario. Possible buyout candidate, we'll discuss buyout economics as well. Owner-operated company, so that aligns our incentives with management. Strong balance sheet, debt-free. Very few brewing companies have no debt on their balance sheet. That creates financial flexibility to reinvest in the business in a downturn like now, which they've done. It can be very difficult in tough times to launch new products, or they can buy back stock, which they're doing. We think this is an uncorrelated investment. It's got its own idiosyncratic catalysts. They kind of have self-help elements. They're gaining efficiency through one of the things is they have a lot of contract brewing arrangements that were struck during the peak of the hard seltzer bubble, which have caused them to run under capacity and have to pay shortfall fees to those contract brewers. Those are now rolling off. So we're going to have this inevitable tailwind to their operating margin, which has been quite depressed. So that's really non-correlated to anything in the market or geopolitics. And these new product launches are unique to Boston Brewing Company. So in a time when there's a lot of macro risk in the market, people are worried about tariffs and geopolitics and inflation and high interest rates. This is something that's kind of insulated from a lot of those risks. It has its own unique risks. Concerns I have, why is this not a value trap? The two biggest mistakes I've made in my 30-year investing career are selling winners too soon and buying value traps where something looks cheap, high quality, but it languishes for very long periods of time due to usually maturity of the product or some other kinds of headwinds. I think we have some things here that offset that. One is the innovation. A lot of value traps don't usually have an element of successful innovation and new products being launched to create growth. Shortfall fee roll off. I think it's a very hard catalyst to margins improving. And then the owner operator oversight. A lot of value traps tend to have poor alignment of incentives. In this company, we have a really good alignment of incentives. Second thing, moderating alcohol consumption trends. There was a lot of overconsumption that happened during the COVID era. I think we're now correcting from that. The beer category is shrinking about 1 to 2% per year, and we may be under the long-term trend of alcohol consumption, which has been 1 to 2% over the very long term. We may be under that trend for a number of years, 3 to 5 years. So that's a headwind that we need to build into our models. Can Truly really offset its decline, and can Twisted Tea stabilize itself? All it needs to do is stabilize itself down 5, 10, 15% for it to be a really good scenario because the market's kind of betting that Twisted Tea is going to lose a third to half of its volume over the next few years. So that would be the win there. Tariffs, if tariffs do remain in their original form, the company said it can be a $20 to $30 million hit due to aluminum cans, promotional materials, ingredients. We think it won't ultimately be that bad because either tariffs will get negotiated downward. Our view is that a lot of the tariff strategy was negotiating opening salvos, very severe salvos to create bargaining leverage for other political objectives. So we'll see a moderation. And I think also there's supply chain adaptation. The company's already shifted some of its ingredient procurement from Canada to Montana for things like hops. There's other ways to offset the aluminum can business. 70% of it is recycled, so that's actually happening domestically. So there's ways to offset some of this, so it may not be as bad. Too much innovation is one of my other concerns. Do they spend too much effort launching too many new projects that end up consuming a lot of resources? And would it be better to chop off maybe the bottom 20% of their SKUs or their new product initiatives to focus more of that energy on the things that are more promising? Finally, management succession, what happens after Jim Cook? I do think it's a different company after Jim Cook. I don't think he can be replaced. I think there are competent people in all functions inside the company that could continue running it for sure. But I think it would be a diminishment if he were not involved. I think if he doesn't, if he leaves the company or something happens, I think that could be a catalyst for the company to be sold. But I'd rather see it, compound with him in place for a long period of time. To my point about too many new products and declining efficiency, you can see this is a whole chart of return on invested capital. You can see the company historically had great CFROI, very good spread of cost of returns over cost of capital. Then the hard seltzer market crashed in 2021, and their returns crashed and have been struggling to recover. It's just beginning to start to show signs of it. Meanwhile, asset efficiency has been gradually eroding, although it has stabilized a bit. And I think this could reflect, they're so long-term oriented that they tinker in the lab and invest a lot of money in projects that maybe don't pay off. So it's an opportunity for the company to get more efficient with how it's allocating resources. So let's talk valuation.